In the complex world of property insurance, a traditional one-size-fits-all pricing model is being challenged by a more nuanced approach. How can insurers, businesses, brokers collaborate to create a fair, sustainable insurance ecosystem that rewards effective risk management? Welcome to the Policybazaar for Business show partnered by ET Now. I'm Kavita Thapliyal, and today we are going to explore the critical need for risk-based pricing and its potential to transform the property insurance landscape. Joining me in this conversation, we have Puneet Panchal, Vice President and Head of Insurance at Cube Highways, Prabdeep Batra, Chief Distribution Officer, Reliance General Insurance, Amitabh Dewan, Associate Director and Business Unit Head, Policybazaar for Business. Welcome all of you on this very special show that we're talking about property insurance market. But then for our viewers, let us understand the current dynamic of this market. Maybe you want to start.
See, Kavita, the last 25 years, a lot of changes have happened in the insurance industry. I mean, just to put things in chronology, 2000 was the year when the sector got privatized. So before that, we had 4 public sector companies and we had one reinsurer, which is GIC. And the first private sector licenses came in the year 2000. And at that point in time, we had this tariff regime. What we mean by tariff is that the prices were absolutely fixed. And within tariff, you had few discounts. For example, if you had fire extinguishing appliances, you got some discount. And if you had less of claims, you also got discount there. So this happened till 2006, from 2000 to 2006. 2007 was the year when regulator wanted to have free pricing and free wordings. So they went for de-tariffication. So de-tariffication happened in 2007. So discounting went for toss, and 2008 they said that probably we'll try the, they would like to have changes in the wordings also. So you can have your own free wordings. But that did not happen because the pricing went for toss, and so that did not happen. So from that, 2007 till 2019, we had that kind of scenario. And then again, the regulator said that probably everyone is kind of losing money. So they went for burn cost. When I say burn cost, so for few occupancies, they said the rates will be little higher. So that happened for few industries. And then all the industries came in 2020. So all the industries, close to 300 industries, so the rates were fixed. So everyone was, given the same rates and the same rates were charged. And from 2020 till 2024, this happened. And 2024, because, we had a regulator and they wanted, insurance for all that kind of environment. And so they said that probably from 2024, we'll have de-tariffication, which will happen. So 1st April de-tariffication happened, this 1st April of 2024. And 9 months again, because de-tariffication happened, so nothing happened on the coverage part, but pricing again, everyone went for all kinds of covers and all kinds of, prices. So that happened for 9 months. And then again, 1st January, everyone came together and they said that probably we would like to go for again a tariff kind of regime. So the long and short is last 25 years, we have been having this kind of scenario. 5 years, we had tariff regime. Again, for almost 10 years, we had free pricing. Then again, we had this burn cost kind of thing. And again, from 20 to 24, we had these, fixed rates.
Right.
And 24 to 25, we had, de-tariffication. And again, going back to the tariff regime. So that's the crux of the last 25 years. So that's where I think the challenge is for the entire industry, So because, if you are an insured, how would you do your budgeting? How would you plan your insurance programs?
Right.
So some kind
and how
of...
do you know that you are covered enough?
Absolutely.
How would you know that?
Absolutely. Absolutely.
And how different are we as compared to West in the current scenario?
So in the West, the market has already evolved over the ages, in fact. And if we talk about India, for decades, in fact, we have this tariffs being there in place, which were regulated by Tariff Advisory Committee, TAC, which had been for the property insurance. And as Prabdeep just elaborated that, okay, over the period of time after the privatization of the insurance companies and then in 2007, the de-tariffication happening, only the prices have been regulated. But never it had been thought of that, okay, the policy wordings should be changed or they should be opened up. But that has not been done as of now, and it was only on the 1st April 2024 that the prices had been, the policy wordings have been opened. But yeah, we know that the markets have quite evolved in the international market, but that adaptability has not come in India as of now. We are just revolving around the pricing
Too much of
regime
focus
only.
on the pricing.
Absolutely.
Why?
So, to be very honest, earlier when Prabdeep and Puneet rightly said, there's not enough data that was available, and it was all the pricing was being done on a traditional basis. So there was a tariff which was defined ages back, and everybody used to follow that blindly. Whenever little steps for de-tariffication or regulating or maybe deregulating the pricing was discussed, people used to take that as a benchmark and provide discounts on those rates. Effectively, the risk-based pricing should not be a discount on the benchmark rates of the tariff. And that's why it should be something where we can talk about that on a particular occupancy, the insurers have a very high risk or very high claims, and hence it should be rated higher. For example, it's a rubber manufacturing company. Maybe an ex-insurer has run very good portfolio on it, and it's profitable for him. He may tend to give you a better pricing on the risk as compared to an insurer who would have many losses or claims paid in the past few years. So this risk-based pricing would actually differ from insurer to insurer,
Right.
as to the background that they have, the kind of claims they have paid, and the kind of portfolio spread it is. Because finally, insurance is a spread of the risk. The better the spread, the better is the pricing that can be derived.
All right. What are your thoughts on innovating this particular sector, especially in terms of coverage? Because every sector has a different sort of a demand. What are the clients coming up and asking you for?
Honestly, what the clients are right now looking for is, because in the past few years after the privatization, there has been a lot of new things that have been introduced in the market, but that's not something which has been widespread across all the sectors. It's some of the booming sectors in India where we are seeing some innovations to a certain extent happening. Effectively, what the clients are looking for is, because the way of doing business has changed, it has evolved over a period of years, and many new risks have evolved, and something which was there earlier does not exist now.
Exactly.
So probably risk management or what we want to work on the wordings part, or also improvising the cover, is that there have to be certain covers which have to be sector specific. Renewable energy company cannot have a similar risk of a pharmaceutical manufacturing company. Similarly, any of the ITES companies or the BFSI sectors have a very different need of an insurance policy as compared to what an auto component manufacturer would have. Because both the activities are different, the risks are different, the exposures are different. So what we intend to work on is where we can probably come up with some kind of a sector-specific wording, or maybe have a specific base wording and we have top-ups on it, which actually help you align the kind of covers that are required.
So Kavita, the way I see at the entire scenario right now is that you have old economy industries, like you have thermal power, which is been there for a reasonable period of time.
Right.
Same is the case with steel, same is the case with cement, pharma, those kind of industries. So when I say those kind of industries, so I think the claims also have got normalized, the coverage also has got normalized as far as those sectors are concerned. Because 50, 70 years, 80 years, so they've been around, we know what the industry is. And the other thing which is again very prevalent right now is the Make in India. So right now we are making Apple phones in India, we are making all the consumer durables in India. And those industries where I think the the age of industry is hardly 10 to 15 years, you need to have covers which are absolutely grounds up. You need to have tailor-made solutions for that. And that's where I think your own skill set will come into play.
Exactly. You're talking about becoming a global manufacturing hub.
And most important, in fact, what we have seen that in the haste of the price discrimination and the competition, most of the times the risk management, in fact, that is neglected or overlooked in many of the sectors. And that is the main area, in fact, where the insurers need to focus now. Okay, because with the new inventions, new technologies, and new ways of operating the business.
How can insurers do that? How are they doing it?
So that's what, in fact, that it's the same system which is coming down the decades, in fact, and there is no change within the policy wordings.
Right.
But then we are still grappling with the same old products in property insurance, where we need to look at the emerging risks, in fact, which would be coming in, like cybercrime is there, or geopolitical risk would be
Cybercrime,
there,
exactly.
or
How do you prepare
perma
for
crisis, in fact,
technology-based?
so if we are not mature enough with the traditional products itself, how we are going to deal with the new products
exactly.
and the new risks, in fact.
Exactly.
So that is a very big concern, in fact, where the Indian insurance market need to have that maturity, in fact, to adapt to the new systems, new technologies, new thought processes, and how we can deal with the new risks, in fact. So that is the need of our as of now.
Technology-based risk management is definitely needed. I think this is across sectors that we are talking about.
Yes. See, because what has happened is, with the evolution and a lot of technology being used into the actual manufacturing or the business operations, also involves a lot kind of a technology deployment from maybe the insurer side or the broker side in terms of the value added or in terms of how the risk is being monitored. Very simply put, like, we have been working on a lot of technology solutions as well to improve the property risks for any of the clients. And a very simple example could be that in a manufacturing hub, there are almost 100 FEA appliances, the fire extinguishing appliances. All of them need to be reserviced and refilled in maybe a 1 year, 2 year, whatever the span is. Since the company, as a manufacturing company, they specialize in manufacturing the kind of product they are into. Insurance is something not which is their core activity. So obviously somebody like us has to get into it. We have developed some systems wherein once we feed in the data as to when a particular fire extinguishing appliances or that particular handheld device is up for a service, there'll be automated reminders going on to the right people within the plant, within the risk, to the risk manager, that see, this is something which requires your attention. These smaller things actually help in reducing the overall impact of the claim.
If we talk about in fact road highways, in fact, so Amitabh was talking about sectors, different sectors. In fact, if we take one particular sector also, the risk exposure can be different for different risks which are located at different places. They could have their own risk management strategies, they could have their own exposures, they could have their management philosophies, their compliance, regulations, adherence. There could be completely different among the one sector itself only. A risk or a road highway on a coastal region, or a road highway in the mountain region, or a road highway in the Madhya Pradesh. They are completely different with their risk exposures, in fact. And within the businesses, the risk management philosophy could be different. So the unfortunate part is that we are having the same pricing and same rates for all these three occupancies. Despite their good risk management efforts, despite their management efforts being reflected in the lower claim ratios, but still with the lower claim ratios, again, they are paying the same price which a poorly managed occupancy is getting it, in fact. So this shift now has to have been done, in fact, in the market, and that's the need of the hour. But the unfortunate part is that, okay, we have been struggling for over the period of time, in fact, just juggling with the pricing, but coming out of the pricing and then adapting the new solutions or new customized and structured or tailor-made solutions for the particular risk, that is very important.
Right.
And I'll give you again one more example, Kavita. I mean, Puneet's risk, because we have been writing this risk, so, I can talk about that. So those type of risks, you have n number of risks in India, operational road and the kind of risk management services these guys have, they are the gold standards in the industry. When I say gold standards in the industry, so they got the benefit as well. Over the years, I think when the rates went up, so they were the ones who were able to get better rates from the reinsurance market as compared to the markets here.
Okay.
So
so within the industry, it's being rewarded, incentivized. Otherwise,
absolutely.
There is.
So that's what, in fact, the risk management practices, in fact, and how they are turning to your lower claim ratios, in fact. So there is a track record, in fact, if we say that, okay, for 7-8 years we have been operating at less than 10% claim ratio, where the road industry is operating at 40% around. So as compared to that, if we are investing so much in our risk management activities, there are new technologies being adopted, there are new materials we are testing, there are so many safety and security measures, in fact, we are taking on our road highways. We are testing optical fibers on the road highways to sense the anomalies of the road or any accidents happening over there. So if these kind of work is, we are working on new materials, in fact, the pavement materials which are quite resilient and up to 3 times more resilient for the flood and heavy rainfalls as compared to the earlier materials. So this way, in fact, we are reducing our exposures, our claim ratios, but then of course we want that incentive from
you need that boost.
insurance
Totally.
premium
Yeah, and this will be across the board.
We cannot pay the same kind of premium which a poorly managed road sector is doing.
Why should he be penalized for someone who is not managing the risk well?
Totally.
And if he is managing the risk well, he should be given better discounts, and better long-term, plays. So, and I think that's what he got.
What is the current status of competition among stakeholders?
So the current competition, I'll tell you, the wordings that we were talking about remain constant across the sector, across the insurance companies. The only differentiation which in between, like Prabdeep rightly said, in between we ran a phase where the pricing was de-tariffed. That was a time where pricing differentiation did come into play. But effectively, it was it did not last long, and
Which
everybody
is why no benefit seen of that.
No benefit on that, and everybody gave whatever were the maximum discounts possible in any of the risk. So that idea, or we may say that testing of the risk-based pricing did not actually work for us. That's where we all need to probably collaborate, not only as from the client's perspective, as consultants, as brokers, as the insurance companies, where we do understand that what are the benefits. Like Puneet was talking about the investments they are doing in maintaining the roads. That investment is a huge cost. And it's not only a cost which they are incurring just to save some small premium there, but it's actually enhancing or improving the kind of risk they are into. Any kind of an insurance claim has two aspects. You have the actual asset damage and the loss of revenue that can be generated out of it. So it's a larger impact that it will have on the overall sector. When they are minimizing that kind of an impact on a sector, so at least one part which is more on the risk side, which is more where the insurance company is expected to make good those losses, should be ideally rewarded.
And Kavita, talking about the involatility of the market and the uncertainty, it's again a bigger issue, in fact, where for our businesses, in fact, to forecast the future premiums and for the budgeting purpose, it's highly challenging for us, in fact, in this scenario. Because as in our business model, in fact, where we are bidding for the road highways for a concession period of say 15 years to 30 years, in fact. So in the financial modeling, insurance cost is again a major cost, in fact, apart from other costs. Each of the cost, in fact, we can, with some parameters and with the historical background, in fact, we can forecast that, okay, what kind of the cost we would be having in the future. Insurance is the one cost, in fact, where we are always struggling, because let's give it up for 5 years or 10 years, we are not sure about the immediate next year that what will be the cost for the insurance.
No
premiums,
consistency.
Last 2-3 years have been a rock and roll kind of a thing. Sometimes
challenge,
it
in fact,
shoots up and then suddenly it drops and then suddenly it goes up. So even if we were to give any of the budgets,
you cannot, because
we
you're
cannot
just
give
grappling up with the current changes happening.
Just imagine that in December 23, the prices for STFI rates were increased, and then again it was kind of fixed price regime. Within 3 months, on the 1st April, it was completely de-tariffed. The prices were open, wordings were open.
Why so much
Nobody
of
looked
confusion?
on
I really
pricing.
want to know, because
And you would wonder that it took only 3 months, from April to June, in fact, the discounts, in fact, for the Flexa, that is one component of insurance pricing, the Flexa discounts has come down to 90%. They were increasing more, and even the fixed rates of earthquake and STFI, which is certainly not allowed to breach, in fact, they had been breached, and the market has come down to almost 60-70% discounted.
So, Kavita, you were saying that why something like this is happening.
exactly.
So
you guys being stakeholders, I'm sure you make your representations to the regulator as well.
See, the way it works is that if you sneeze in US, you get cold here in India. Something like that, because ultimately at the end of the day, it's all about reinsurance, as I said.
But we are a different country, we have different dynamics. Look at the industry.
Even though I think mandate from the regulator is that the way forward is only de-tariffication, which is free wordings and free pricing. But at the end of the day, I think reinsurers, they want to make sure that whatever we are writing here in India, they have to be at some basic, cost. So that's where I think, capacity challenges then. If you don't have capacity, you will not be able to write the risk.
Right.
Let's say something like which is 10,000 crores, 20,000 crores at a single location. You just cannot write that risk on your own. You need to have 3-4 partners who will support you. And those partners in turn will be dependent on the reinsurers. And that's where, they want to make sure that, some kind of sanity should prevail. Because it's very easy, at the end of the day, you could have a scenario where someone comes to you with some kind of attention-seeking product. And you could be enticed to go towards that.
Yeah.
But the way large risks they work is that it's not revolutionary, it's more evolutionary in nature. So you have to be a little skeptical as well, because it's balance sheet protection at the end of the day. So that's what it is.
And Kavita, it's more important that, okay, what kind of solution do we find, in fact? How long we would be grappling with this upheavals, in fact, in the market? And it's very important that how we collaborate, all the stakeholders, how we collaborate with together. It could be insurers, the insured, the brokers.
So far, what's the consensus?
Reinsurers, and even the regulator, in fact. Okay. So it's not that, okay, you free up the market and market behaves absurdly and unreasonable, and then again you are coming back and taking out your band and then making it again the fixed price regime.
So can there be some kind of a collaboration or an industry-wide thing that we can do so that it actually enables going step by step into maybe the pricing, maybe the wordings, maybe the de-tarification, as we may call it, but that is something which is the need right now.
But so far as an industry, what are the points that you guys are on the same page with?
See, the most important thing is that, okay, how the risk evaluation and risk mitigation efforts of a particular insured, how they are taken into account, how they are considered by the insurers and the reinsurers, that is most important as of now. In fact, how if we are going towards a free price regime. So taking into account the risk evaluation is the first part, and risk mitigation, the risk management philosophy, the kinds of studies they are doing, the employee trainings, it could be there could be various CAT modeling, it could be structural audits, it could be compliance audits. So all these parameters, in fact, they should be taken into account by the insurers, and accordingly that sector wise, in fact, specific products can be made, and with that equitable price, in fact, that has to be adjusted to those profiles.
Okay.
See, my sense is, Kavita, that you have this mandate by the regulator, insurance for all by 2047. This has to happen, right? From the retail perspective also, and from the corporate perspective also. So there are two schools of thought. One is, that you need to have de-tarification. Having said that, there need to have some kind of balance as well. When I say balance, so you need to have that kind of collaboration amongst all the stakeholders. So that's how, you will have de-tarification also, and you will have the balance amongst all.
Now?
We are still struggling as we speak, but I think that's the way forward. And ultimately, I think we will have some kind of equilibrium that will come in. My own sense is I am very optimistic that, all the stakeholders will come together, because at the end of the day, from the regulator, you still have this concept of protection of policyholders' interest.
Sure.
At the end of the day, if I am giving you a policy, I have to honor that policy. You have the data also right now. When you have data and on top of it, you have artificial intelligence also. When you have data with law of large numbers, I think that sanity will happen.
No, I 100% agree with what Prabdeep is saying. And the best part is because as the clients are ready to invest into this risk management, the insurers are ready to accept those practices and give certain discounts. It's our role as brokers, as consultants, where we bridge this gap. We go back and say that, yes, these are the good features of a particular risk, and that's why they are eligible for a particular discount. And it's not only about what risk management they're talking about, some of the features on the risk, but also it depends on what kind of a business continuity plans they have.
Sure.
Because that will tell you as to how soon they can come back to the normal operations. Giving all of those conditions, telling the good features of a risk, which actually makes the insurers very comfortable in underwriting, is something what we want to achieve going forward.
Absolutely. Couldn't agree more. Absolutely.
I think a lot needs to be done and a lot needs to be asked also, but my time is up for this particular session. Thank you so much for taking your time.
Lovely having this chat with you, Kavita. Really enjoyed this conversation with you. Thank you so much.
With that, our special feature of the Policybazaar for Business show partnered by ET Now comes to an end. Thank you so much for watching.